Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com. Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Andrew Reichert and Daniel Croce. They are co-founders of BERGO Realty, a Pittsburgh-based private equity real estate firm with over $270 million in assets under management across over 2,800 multifamily units. It is a vertically integrated company with over 80 employees handling everything from property acquisitions, asset management, to on-site property management. So thank you two for coming on the show today.
Yeah, thanks for having us, Charles.
Glad to be here.
So tell us a little bit briefly about yourself, your backgrounds, both personally and professionally, prior to getting involved in real estate investing.
Sure, I'll go first and I'll let Dan go. So personally, I grew up in a family that was not entrepreneurial, not into real estate. And so kind of first generation entrepreneur, first generation real estate owner, and really just kind of fell in love with it through college, reading books like Rich Dad, Poor Dad, and how to invest in real estate, and started reading every book on zero money down because I didn't have any money. So bought my first duplex the year I graduated from college, and kind of the rest is history. I bought a duplex with no money down. Actually walked away from closing with a check for 20 grand and used that to buy more real estate, and then refied that, used that to buy more real estate, and then we got into business together.
Nice. Awesome.
Cool. Yeah, and I can reciprocate. I grew up in Western Pennsylvania. My mom immigrated here from Belgium. My dad met her when he was in the Air Force in Europe. And similar to Andrew, my real estate was not in my family, but my mom was always really prudent with allocating resources. So she was interested in investing. I remember her poring over stocks, and they didn't have much, but they were really diligent with what they did have. It's funny. I actually remember in 2011, I suppose it was, I got a $5,000 inheritance from my grandmother, and I thought, I don't want to put this in the stock market. So I hopped on Craigslist, and I found a row home for sale for 19 grand. So I put $5K down, borrowed 14. My payment was $162 a month, and I got $600 in rent, and was addicted to getting those passive rent checks. So that's how I got into real estate. And like Andrew said, professionally, my background was in accounting, so I was working for a big four public accounting firm, but building my portfolio on the side. And eventually, Andrew and I linked up, and the rest is history.
So kind of moving forward to what you guys do now in your firm. So I always find it interesting when there's firms that focus on a number of different asset classes. So you guys are in multifamily, mixed use, office, medical office, retail. So can you kind of give us an overview of what your investment strategy is, and what is your criteria when you are acquiring these properties?
Well, Charles, that's a little bit incriminating because you're highlighting the fact that we didn't used to actually really have an investment strategy. We just bought stuff. That's not true. Our first fund, our strategy was multi-asset class. And a third of our first fund was allocated to a mixture of service-oriented retail and mostly medical office properties. But somewhere along the line, really as a result of some sort of crucial conversations that we had with some of our investors, in our second fund, we decided to be laser focused on workforce housing in the heartland. And so while it's true that we do still own and operate a diverse type of properties, and we've even gotten to the short-term rental business with Airbnb. We've dabbled with a little bit of everything, but in recent years, we've gotten laser focused on doing one thing, and that's workforce housing in the heartland. And so, yeah, that's what worked for us. Thankfully, we've done okay in some of the other stuff that we did, but I think, it's just in terms of focus and trying to be really good at one thing, we've decided to roll up our sleeves on workforce housing.
Yeah, it also makes it easier, I would imagine, with managing that, because it's now you have one kind of, you have one property type that you're always renting out. If someone moves from one property, you bring them to another property. It's not like with your commercial where your vacancies can really kill you because they go for much longer. But can you just, Daniel, you talked about workforce housing, and just so people know, can you explain what your definition of workforce housing is and how you guys work that into your strategy?
Sure. And I'll tell you that that's another somewhat incriminating question because we don't have a super crisp answer to it. We've at times sort of shifted a little bit in terms of how we think of what workforce housing actually is. But for us, it's affordability. We're in the Class B, C space, or C plus, B minus space. And so, kind of a litmus test thing. We're not doing anything that's Class A, anything that, is not super affordable for the common man. You could think of it in terms of, percentage of income. We tend to be below 20% of income is where our rents are. So pretty much everything we do is what Fannie Mae and Freddie Mac call naturally occurring affordable. So that would be sort of one litmus test for us is in the eyes of the big agencies that they call it naturally occurring affordable.
Yeah, that's a great little pocket because you're in that it's a very solid, tried and true, let's say, part of the market where it's not disrupted as much when you're going through all these different parts of the market cycle, I feel. And, you're not in low C where you have issues, and you're not in high B or A where people might be buying houses, or those jobs, someone loses their job in one of those households and they really have to cut back and they're coming to one of your workforce housing properties. So when you're buying these properties and like how you're working with your investors, how are you normally doing a investment horizon? What is your time frame? Do you have a set one? Do you have some investments that are more long term, maybe 10 years plus? Do you have ones that you tell investors, hey, we're going to do this in 5 years, or how does that usually work?
Yeah, so we have done things a little bit uniquely in terms of how we've structured our business. And some of that is just my background. I was a fund manager of different kinds of, not real estate funds, before we started our first investment vehicle, the fund manager. And so we just started a fund with our first investments back in 2015. And it was a 10-year fund. And so that gives us a really clean time horizon. We were buying assets in 15 and 16 with the plan to hold them through 2025. And then we started a second fund in 2018. We also called that a 10-year fund. But actually one of the things that we've learned is that that's a really long time to have a hold period and achieve consistently very high returns. Mm-hmm. So you can add value in those first couple of years, and then you refi out, and it's kind of hard to get that consistent value pop. So something that we did last year was form an evergreen fund, and that's a vehicle that enables us to buy assets that are really high quality, but we think we want to own them for 15, 20, 30 years, but maybe not have these giant value pops, but just kind of slow and steady singles and doubles. And then as it would turn out, we just last month launched a new 5-year fund that's an opportunistic fund. So we think of hold period in terms of what investment vehicle are we investing out of, and what's the thesis and horizon for that particular vehicle. But I'd say it can be anywhere on the low end to 2-3 years. We just want to get a quick value pop and get out, to indefinite, open-ended, very, very long-term thing.
Yeah, I love the idea of the evergreen fund. That's fantastic, because it's true that you have a lot of syndicators that avoid the evergreen fund because you can't get the high returns. But you have investors that don't really care how long you own a property if they get their distributions. So that's awesome. That's a great way of doing that. And I imagine some of your investors asked you or really like working with you because of that. So, but I want to talk about like how you guys are in one market, you're in Pittsburgh, and I'm not sure what areas of Pittsburgh you are, but how does focusing and specializing in just one market assist your company with really identifying good deals for you and your company and your investors?
So to clarify, we've actually expanded a little bit geographically, but our first many years we were only in Pittsburgh, and I think we really kind of got a corner on the market in terms of a certain asset profile. It's not a huge market, and there weren't many professional capital sources that were looking to do multifamily syndication or multifamily aggregation in our market. And so I think we were able to get really efficient at understanding every nook and cranny of the market, knowing exactly where we did want to be, exactly where we didn't want to be. And also just, the purchasing power that comes with vendors. We're vertically integrated. So all the strengths, working with brokers, we're the known buyer in the market for a particular property type. Even lenders, our local banks, very, very comfortable with us. They have an intimate understanding of the market. So I think it's a lot of those things. And I would say that when we made the decision a couple years back to expand, we went first to Morgantown, West Virginia, and then to Buffalo, New York, and Cincinnati, Ohio. And we now have teams in all of those markets. Inevitably, we just basically 4x our deal flow. Just looking at 4x the markets, we have a lot more deal flow. And so we've actually recently done less in Pittsburgh. It's become a more competitive market. It was sort of a wild west when we were getting started. But now, we're much more open to geographical diversification. One of the things that I think we realized is that it maybe wasn't healthy to be so concentrated in Pittsburgh. It's we like the market because it's diverse in its economic base. There's no one industry that drives the entire economy. And yet, what if one or two of the big employers went under and all we have is real estate in Pittsburgh? Well, you'd feel it pretty painfully. So we've diversified a bit over time.
Yeah, it's a really smart move.
Still love the steel city.
So you mentioned vertically integrated. How do you feel, let's say, that benefits you and your investors?
Yeah, it's a great question, Charles. I think there are pros and cons both ways, and I think you just kind of have to pick a lane. So we picked the vertically integrated lane in part because we wanted to control the end product, which for us is, providing a home to a tenant. So we wanted to control that experience. We wanted to control the experience of customer service, but also of maintenance and capital expenditures. We wanted to, really be hands-on with those tenants to make sure that we understood, hey, if the tenant says, I've got this particular issue, we wanted to make sure that we're diagnosing how to resolve that issue, ourselves, as opposed to having a third-party person, they have their own incentives typically, telling us, what they think the issue is. Now, that said, again, there's pros and cons both ways. We had to build out the staff and the team in these markets, and that comes inevitably with growing pains. We've had to learn, new vendors in new markets. Whereas if you hire a third-party property manager, they typically have those relationships existing. So certainly hasn't been perfect, but that was the lane that we chose, and is kind of really tied to how we think about our purpose and our mission, which is really caring for the tenants. And so we wanted to really control that process.
Yeah, you definitely have a lot more control when you're doing the vertical integration, because there's just so many variables with property management. And if you're able to control those, I would imagine, because I've passively invested with a lot of groups that have their vertically integrated. And I think it's a little bit more streamlined when you're getting answers to questions you're asking about how properties are being operated, because it's all the same company. And so it's, technically it's all the same company. So, but that's very interesting. Andrew, one thing, like I know you were talking about bettering lives for your tenants. And I know you guys have a company slogan of improving lives through real estate. And I think as a value add syndicator myself, when you're buying properties, I think tenants are really a little worried when ownership changes. They don't know what's going to happen. They don't know if they've got a slumlord coming in. They don't know if their rents are going up, which they usually are, because we're normally going to these properties and improving them. I mean, how does that feel? I mean, how do you guys feel that you are really improving the lives of your tenants and their neighbors when you're going into a new property or a new neighborhood?
Yeah, it's a great question, Charles. So first of all, taking a step back, if you look at our mission of improving lives through real estate, we really think of that with four primary stakeholders, being our tenants, our investors, our employees, and the communities that we serve. And all of those are lives that we touch every single day. And so one of the obvious things that presents, or one of the obvious challenges that presents, is a natural tension between improving the lives of our tenants and improving the lives of our investors. Because some might say, well, an easy way to improve the lives of the tenants is just to, pour money on them, right? Fix every issue that they want, lower their rent, right? That would really improve their life. Well, that's not going to improve the lives of our investors. And sort of vice versa. I mean, one thing you could do is squeeze every penny out of a property, and that's probably going to improve the lives of our investors. But we actually think that would not only be detrimental to our tenants, but actually detrimental to the performance of the property. So for us, it's about taking a holistic approach to the lives that we're improving. And so what does that look like? Well, you mentioned value add and adding value to the property. So inevitably that might cause rents to increase. Well, for us, we view improving lives through real estate as it relates to our tenants, with really providing excellent customer service, 24-hour maintenance hotline, caring for them, in a way that we think provides them with clean, dignified housing that many folks, in the workforce housing space actually don't think about that as a key pillar to their existence. We do think about that. Like, let's make sure we're providing somebody with a house that I would want to live in, right? If I wouldn't be comfortable living in the apartment, we shouldn't be renting it out that way. So that's sort of our litmus test. What it doesn't mean is that we're giving rent breaks or otherwise making bad financial decisions, because we actually think that would be not providing dignity to those same tenants. We think the dignified thing to do is actually to treat tenants, as human beings, and therefore treat them as folks who are responsible and can make responsible decisions. And if we add value to a property, we usually try to do that in a way that shows care and love. And yet, if rents need to go up, rents need to go up. So we try to balance that, and it's not easy. It's a tension that we work through every single day, but we live in that tension, and rather than trying to avoid that tension, we just really lean into it and try to do the best we can for our stakeholders.
Yeah, that's a great answer. What I found really with tenants is that most of them will pay a little bit more if the property is being run correctly and a lot of issues. Because how many times have you you've walked through units in a due diligence and you have tenants just complaining about stuff that, it's been months and months and the current landlord or management company has just kind of put them to the side. And so I think people will pay more, I feel, for a better product, a safer place, a cleaner place for their family and themselves. That's what I found. So,
yeah, we found the same.
So you guys have obviously a very successful partnership. And I find that when in commercial real estate, especially in larger firms like your own, it's a pivotal part of how your business runs. So can you explain how partnerships have been so important to, between you two and then between, your company and other companies for the growth of your business?
Yeah, absolutely. I can take a first stab at that. I'd love to hear Dan's perspective as well. Well, first of all, I think partnerships are one of the most amazing things, that you can kind of enter into, and also one of the most challenging. So I think what makes partnerships so amazing is, and particularly mine and Dan's partnership, is the diversity that exists in between us. Dan and I are like wired as total opposites on every single personality test. Everybody knows the DISC. I'm a high DI. Dan is a high SC. We're just wired differently. And so that creates really incredible strength for an organization like ours, because we just bring different things to the table. That also creates challenge. We communicate differently. We prefer to be communicated with differently. We think differently. We think differently about the financial performance of our assets, and we think differently about how our mission, some of the things we just talked about, how that relates to tenants and investors and our various stakeholders. So one of the things that I would say, first of all, like, we work really hard at that. We're very intentional about our relationship. And one of the things that we realize is that we have to lean into, that diversity, and lean into the things that make us different, and actually value them, and allow them to manifest themselves in our relationship. So it's definitely true for our partnership. I would say that's true for, our relationships with employees and direct reports. We try to take that same approach. You've probably heard the golden rule, treat others as you want to be treated, but there's like this platinum rule, which is treat others the way that they want to be treated. So in other words, if a person prefers email communication, as opposed to, verbal processing, my approach to that person needs to be that I'm going to send them a detailed email and work through it in email. So I think partnerships really it's understanding the other person, and also having the self-awareness to be able to interact in the way that is most valuable in that relationship. I would say, as it relates to other partners, lenders and other folks that we work with, we take a similar approach, which is, how can this be a mutually beneficial relationship? It's not about take. It's about, frankly, our posture is typically give. It's like, hey, how can we add value to this person, right? If this is a lender we're working with, how can we really make the experience incredible for them? How can we be a great client for them? How can we really be a standout partner for our vendors, our landscaping vendors, our, snow plowing vendors? How can we pay them quickly and make sure that they come away thinking that they're having a great experience with us? And we just find that if we take a, others focused approach, that really adds value to that relationship and ends up actually benefiting us as an organization as well.
That's a great answer. I love that about the vendors, and it's kind of making the relationships less transactional and more of a true relationship. So that's awesome, Andrew.
Yeah, Dan, what would you change or correct about what I said?
I wouldn't change or correct any of it. I would just add a couple bits of perspective from my side. I think Looking back on the history of our partnership with Andrew and myself, I think we've grown a lot over time. And I think one of the elements, a couple pivotal elements that have helped us grow, I think is one, just making a shift to Andrew's point, away from like, what do I want? And more to what do you want? Where do you want to go? And how can I help you get to where you want to go? And then reciprocating. And I think in our case, the answers are different for each of us. We want different things. We have different goals. And so understanding, where does the other want to go and how can I maximize my efforts to help them get where they want to go, I think. And then, collectively taking that posture, I think is extremely effective and energizing. And it's worked. And the other thing that I would say too is that I'm on sharing these details. We started as 50-50 partners in our early days. And I think that was not healthy for us. So there was no tiebreaker. We were both in charge and both. And so we just butted heads a lot because we wanted to call the shots and we had different, as Andrew mentioned, a different perspective. And so somewhere along the line, and to the point of, asking the question, where do we want to go? Well, Andrew is really wired to be the CEO of a business and to build this thing to get to $1 billion in AUM. And I have different goals. I want to do some other things in life and I want to be a part of what we're doing here, but I want to spend time on some other projects. So we realized that the best thing here is for Andrew to be the single point of accountability, the one who ultimately calls the shots. And I'm here to support in whatever way I can. And I'm going to win along the way. So I think that was a very helpful shift for us, just to say 50-50 is probably not going to work. And I've taken that approach into any other business dealings I have with other partners. I think there needs to be that single point of accountability. And I think that's been incredibly helpful. I would also say too, this partnerships in terms of other people. To Andrew's point, I think it's taking a servant's mindset. I mostly think about our investors. My role has been recruiting a lot of capital and thinking of them as partners and thinking about where do they want to go? How can we get them to where they want to go? They're not just a source of capital, but they're people. They care about accomplishing their goals. And so I think it's just taking that servant mindset and the true partnership posture of how can we collectively bring what we each have to get each other where we want to go.
Great answers. So one thing I want to see is with your company growing 80 plus employees, what have you found to be your biggest challenges over the years?
Yeah, great question, Charles. So it's an interesting question because I would say each season has brought its own new set of challenges. So, growing from 0 employees to 5 had a whole set of challenges, right? Now we're running payroll and we got to figure out HR policies, right? Employee handbooks. That's like the startup phase of challenges. Growing from 5 to 50 had its own set of challenges, right? Now we're talking about how do we scale systems and processes, and is our accounting system, ready to go to handle this growth, and our HR systems. And so I think that was a very systems oriented growth phase. And now we're trying to grow from 50 to 500, right? We're at like 80 some employees and growing quickly. And that brings its own set of challenges. And I think what I'm finding is that those challenges are often wrapped in getting the right people on the bus. Oftentimes the skill set that's required to run a 1,000 unit portfolio is just very different from the skill set that's required to run a 10,000 unit portfolio. And so we're finding ourselves really trying to hire the right people to help get us to that next level. So I think personnel and, hiring, managing, and when necessary, parting ways with team members is really the primary, focus and challenge that we find ourselves in today.
So before we wrap up here, I just want to see for each of you, what do you think are the main factors that have contributed to each of your successes?
Yeah, good question. Dan, you want to go?
Sure. I mean, I would say that I think we've had a lot of good fortune. Like, things have worked out well. We bought at the right time, but it wasn't really I wouldn't say there's anything particularly special about us. We've worked hard. I think we've tried to stay humble and put one foot in front of the other. But in general, I take the perspective that gratitude is one of the keys to life. And so I think I would mostly say it's the good fortune of the blessings that we've been fortunate to have, but also working hard, putting one foot in front of the other and staying humble.
Yeah, I would echo those for sure. I think those are some of the keys to success. I would also just underscore a few things we talked about in the conversation. I think like diversity of team has helped us and actually been a competitive advantage of ours. Having folks wired differently that care about different things and are just wired to think differently has been a key to success. I would definitely say like our mission has been a key to our success, like actually taking a people-oriented approach and caring for, our employees first and foremost, because our employees are the ones who interact with our investors and our tenants. The way we think of that is, hey, if we take care of our employees, they'll take care of our tenants, and the tenants will take care of our investors, right? So really taking a approach to caring for our employees in a deep way, I think has been a key to our success. And then last, Dan brought up a great point with good fortune and gratitude. I think just taking a humble posture. So humility is one of our core values, and oftentimes we don't know what we don't know, and we're not afraid to say it. So I think people are attracted to humility and like kind of repulsed by pride and arrogance. And so we just take an approach of, hey, we're trying to figure this stuff out. We don't have all the answers. Do you want to come journey alongside of us? And I think that has really helped us to be successful.
Well, fantastic. So how can our listeners learn more about you and your businesses?
Yeah, sure. Our company's called BERGO, BIRGO. So BERGO.com is our website. We're as Dan mentioned, we launched a fourth fund. So our fourth fund is on our website. We're typically always raising capital. And if any listeners are in the Pittsburgh, Cincinnati, Buffalo area, and you're looking for a good home, we've got some rental units. So you can figure all that stuff out on our website.
Awesome. Well, I want to thank you guys, Andrew and Daniel, for coming on the show today. And I'm looking forward to connecting with you guys face to face at some point.
Yeah, looking forward to it, Charles. Thanks for having us.
Thank you. Hi, guys. It's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.